Welcome to our monthly view from the Edge for February 2021. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and with me here today is Eric Biegeleisen, Director of Investment Research. In addition, Eric was recently named as Deputy Chief Investment Officer here at 3Edge Asset Management. So, Eric, congratulations, very well deserved.
Thank you very much.
As we do each month, Eric and I will discuss our outlook for the global capital markets, which is based on our proprietary research model. We have a lot to cover today, so let's get started. This week, the global equity market rally appears to be back on, at least for the time being. Investors seem encouraged by the U.S. Senate's vote to adopt a budget blueprint for Biden's $1.9 trillion coronavirus relief package, and a weaker than expected jobs report on Friday reinforced the need for additional fiscal stimulus under the heading of bad news could be good news for the market. While global stocks advanced, yields on U.S. Treasuries climbed. So now, before we dive into our latest model research outlook with Eric, I wanted to just explain very briefly one factor in our model that we refer to as narrowing high yield credit spreads. And you're going to hear Eric talk about this later on when he talks particularly about the equity asset classes. And high yield credit spreads are just simply the difference in yield between U.S. Treasury securities, which are effectively risk-free, and high yield bonds, often referred to as junk bonds. High yield bonds represent corporate debt rated below investment grade, and so therefore comes with higher risk. And based on that additional risk, high yield bonds offer investors a higher yield. And so when we talk about narrowing high yield credit spreads, we're simply pointing out the difference in yield between U.S. Treasuries and a basket of high yield corporate bonds. And currently, yields on high yield bonds are lower than they have ever been. And the difference between high yield and U.S. Treasuries is quite small, or as we say, it's narrow. Now, all else being equal, narrow credit spreads could be a signal that the economy is healthy, that corporations are profitable, and that therefore they're more than able to service their debt. However, at the moment, all else isn't equal in the high yield corporate bond market. And that's because the Federal Reserve, in response to the economic fallout from the coronavirus global pandemic, has taken extraordinary measures to shore up financial markets. And that includes their commitment to buy corporate debt in the marketplace if necessary. And investors have perceived this declaration as the Fed backstopping the corporate debt markets, thereby removing credit risk from corporate bonds. Now, importantly, this is investors' perception of the Fed's stance. There's no guarantee that they would do so. So as we know, interest rates are very low. And so also we have the factor that investors are reaching for yield, if you will, and they're buying high yield debt in an attempt to capture additional yield from fixed income. And this is driving yields on high yield bonds lower and helping to narrow credit spreads. So although credit spreads are narrowing, we're paying close attention because they may be narrowing for reasons that are less related to a healthy and growing economy and more related to the Fed's policies in response to the economic fallout from the coronavirus pandemic. So hopefully that was a helpful explanation about the extenuating circumstances contributing to narrowing high yield credit spreads. So now let's turn to Eric and look at the major asset classes that we model. We'll look at our investment universe. And why don't we begin by taking a look at the equity markets, starting with Japanese equities, which remain our highest ranked equity asset class and have been since last fall, I believe. So what does our model tell us about our current outlook for Japanese equities, Eric?
Yeah, I think that was a great summary, Fritz. And I think that the key point of bringing up this high yield spread change factor, and I think that's the key, is that it's the high yield spread change, not just the actual high yield spread. It's not the absolute level that we care so much about, but more the rate of change, the direction that it's headed. And why bring it up at all? And I think the key, and as you know, is that all four of our major equity asset classes that we model are being very heavily influenced in terms of our projections and our outlook on these asset classes. So therefore, that creates a bit of instability in these projections. If you think of a house on pillars being supported by columns, if you only have one column supporting that house and that column is high yield spread change, but it's a really strong signal, that's great while it's strong. But if that one pillar goes down, the house falls. So it's an area we're looking at very closely. In two of the four equity markets, it's pretty much the only driver of bullishness in the asset class, while there are some other factors in the other two equity asset classes, and we'll touch on all this. But that's why we're focusing so much on it. As it pertains to Japanese equities, these equities have the most attractive valuations across the four equity asset classes regions that we look at. The other three, European developed, US, and emerging markets, are all overvalued by our measure. So what are we seeing in Japan? We're seeing the continued steepening of our yield curve measure for the region. This is generally a good sign for future economic growth, so that should bode well. Also on the horizon is this potential for a self-reinforcing virtuous price movement upward. Think of it as a positive momentum as investors act as a herd, not necessarily in a coordinated GameStop type of way, but in a way to push price momentum up and it draws in more capital and more investors to new highs. So all of those are helping create a positive outlook for Japanese equities.
Excellent. And so then why don't we look at emerging market equities, which are not as attractive this month as they were in the prior month. What are we seeing there?
Yeah, so to be clear, we still find value in emerging market equities. They are overvalued by our measure, but they are benefiting from this tightening of the high yield spreads that we've been talking about. But as you alluded to, they're not as attractive. And the rationale, towards the end of the month of January, we started to see a small uptick in the short-term interest rates across China, India, and Brazil, the three major economies that we're focused on within the emerging market region. And so that has the effect of flattening our yield curve measure for the region, which softens the future economic outlook. Now, is that just a short-term move or the beginning of a trend? We don't know. But all that said, EM still maintains a positive outlook.
Excellent. And it will shift back here into the U.S., still significantly overvalued in terms of our model. What are we seeing there?
Yeah, the U.S. equities have remained overvalued. We've been talking about that for quite some time. It sounds like a broken record, all continuing to just hit new highs in terms of our entire 150-year analysis of U.S. equity markets. More overvalued than prior to the crash in 1929, more overvalued than just before the tech stock bubble in 2000. And yet markets keep going up and to the right. So at some point we do expect that to come down to more reasonable valuations, but the timing of which is certainly unknown. You still have a Federal Reserve willing to do what it takes with no indication of letting up. You talked about that, including support for the corporate credit market, which you touched on earlier. There's the potential for this fiscal stimulus program from Congress. You also have positive earning reports coming out for the fourth quarter, which are collectively leading to this positive investor psychology, future hopes of opening up and vaccine distribution ramping up. So there is a positive outlook overall, but it's certainly being heavily influenced by Fed policy.
Excellent. So our fourth equity asset class is European equities. In the fourth quarter of 2020, European economy actually suffered a double dip contraction due to the additional restrictions to contain the resurging coronavirus. What's our model research indicating there now?
Yeah, Europe's had a mixed outlook in the model. As we've talked about, it is another one of these overvalued asset classes. It's certainly been in that overvalued territory for some time. But like other equity asset classes we've also talked about, it's benefiting from this tightening of high yield spreads, corporate credit spreads. And so those two are largely netting each other out right now. It's not clear that one is winning over the other like we're seeing in other asset class spaces. So right now it's more muted, mixed, or neutral outlook.
All right, excellent. So why don't we switch now from the equity market to the bond market, both interest rates and corporate credit. We've seen the yield on U.S. Treasuries continue to rise. So what is our model research indicating for fixed income?
Yeah, we maintain a negative outlook on treasuries. We've noted for some time now that treasuries are yielding less than the market's expected inflation rate. That is, treasuries have a negative real yield to them. So, even this small uptick in rates that you mentioned earlier that we've seen, the 10-year rising, the risk return trade-off, even at these levels, is still unattractive.
Mm-hmm. Excellent. Great. So let's now talk about real assets, gold and commodities, starting with gold.
Yeah, so gold, provided that real yields remain negative, which they have, gold will likely just continue to be favored by our research. This could be helped further if the negative real rates get even more negative. They largely remain flat throughout January in that negative 1% or so range. A larger than expected fiscal stimulus from the Biden administration could also help gold. And then in terms of commodities are a deeply undervalued asset class by our measure. and the prospect for continued, U.S. dollar weakness, along with increased demand from China and other emerging markets for recovery, that could also bode well for commodities.
Excellent. And then last, short-term fixed income or cash equivalents. It seems though our model continues to find more investment opportunities beyond holding cash, at least for now.
Yeah, I know. I know. If at times now with the markets as frothy as they are, it feels like you just want to sell everything and go sit in cash because it feels like things have to go down at some point. But our research is indicating pockets of value. We talked about it: Japanese equities, emerging market equities, to a lesser extent, gold and commodities. So, if you're thinking of selling your holdings and going to cash, I'd instead urge you to, at least consider just ratcheting down the risk level in your portfolio rather than just selling everything.
Yeah. Right. Excellent. Okay, great. Eric, thanks for getting us caught up in terms of our model research outlook. And now, as we do each month, I'll ask Eric for his 3 most important takeaways from today. So what do you have for us this month, Eric?
All right. Number 1, U.S. equities alongside European and emerging market equities are all overvalued. Reversion to the mean is likely, though the timing is unknowable. So just be cautious of widening credit spreads. 2, Japanese equities are fairly valued, certainly relative to other equities that we model, and offer the potential for attractive upside with hopefully limited downside relative to other equities should things turn down. And 3, commodities are this deeply undervalued asset class and present a potential for attractive upside opportunity.
Excellent. Great. Well, Eric, thank you very much for getting us caught up in terms of our outlook for the global capital markets. Eric and I will be back again early March with the next edition of View from the Edge. Meanwhile, Steve Cucchiaro and I will be back at the end of next week with our latest edition of the 3 Edge Weekend Review. All of our videos are available on our 3 Edge YouTube channel and on our website at 3edgeam.com. So on behalf of everyone here at 3 Edge, we urge you to remain safe, stay strong, keep the faith, and thank you very much for listening.